the possibility of a U.S. default and really just take a rational look at it without, getting into hysteria, and kind of analyze some of the, common misconceptions and some of the, right ways of thinking about it. Now, big picture is that the U.S. government has debts denominated in U.S. dollars, and they have the ability to create more U.S. dollars, through the Federal Reserve, which they control. And everybody knows this, right? The U.S. government can print money, and they can print dollars. So it's very unlikely that the U.S. government will default in a currency that it can create an unlimited amount of. It just doesn't make sense. So I think, the idea of a default, or at least a sustained default, anything that's like meaningful and not just, temporary, is highly unlikely. But, for the purposes of this video, I do want to drill down into what exactly that would look like if the U.S., had some type of temporary default, which at this point, just from a logistics perspective, actually seems pretty likely. It's, getting close to the end of May right now. The official date that Janet Yellen, the U.S. Secretary of the Treasury, has given for the default date is June 1st. So, we're pretty close to that date. It's about a week out. And there's still no deal passed in the House or the Senate. The House Republicans passed a bill, but the Senate, run by Democrats, hasn't approved the bill. And keep in mind, there's just a week left until the default date. And, Congress has gone on recess for the holiday weekend, the Memorial Day weekend. So there goes 3 days right there. You start to wonder, like, even if, Congress comes back on Tuesday and passes the bill on Tuesday, the Senate passes it, how long does it take to get to the president's desk? And how long does it take the president to actually sign it? Of course, things can move quickly in a time of crisis, but I can't, despite there being times in the past where the debt ceiling was an issue, I've never seen a scenario where it was this close or this tight. And so, you sort of get the feeling that everything has to happen right for the outcome to move very quickly and avoid a default on the first. Do I still think it's the most likely scenario? Yeah, of course. Not to default, but that there is some type of resolution reached before the first. But again, for the purposes of this video, we just want to entertain the low probability scenario that they aren't able to reach a resolution, and perhaps they miss some payments. Now we know on next Friday, there's $25 billion of Social Security payments due. It's unlikely that the U.S. Treasury will have $25 billion in its account in cash to pay that bill by next February. So I think the June 1st date that Janet Yellen gave is pretty accurate. In my personal opinion, she probably should have padded it a little bit and given a date that was actually a little bit further ahead than the reality, just to buy herself some time. But this is just where we're at. So I guess, what people are wondering is, how do you hedge yourself against this reality of a default? Like, what is the position you take in the market? How do you trade this in the market? I've seen surveys out there that some people think you buy gold, some people think you buy Bitcoin. I've even seen some people say buy treasuries, which obviously makes no sense, right? If people are, if the government's not paying its bonds, do you really want to buy treasuries? But, in my personal opinion, I think Bitcoin and gold would do very well. I think the dollar itself would be massively devalued over time. Now, it's not clear how quickly that will happen. And what also isn't clear is, in the event of a default, would the dollar not rise dramatically, at least initially? Because you essentially have these large players who have USD denominated liabilities, dollars they owe other people, and they have a lot of U.S. treasuries, U.S. government bonds. So they sort of match those assets and liabilities. So you've got money coming in from your bonds that helps you pay for your U.S. dollar denominated liabilities. Well, if all of a sudden you're not getting those payments from your bonds because the government defaulted, well, you have a major problem servicing your U.S. dollar denominated debt. And in that scenario, there could be a very real shortage of dollars, and the dollar could spike paradoxically. But I really don't see a scenario where Bitcoin necessarily declines in value. I think Bitcoin would also accelerate pretty dramatically in value. And people tend to think of them as moving, in lockstep, that the dollar currency index can't. People tend to think of the dollar currency index and Bitcoin as inversely correlated, because when you're trading Bitcoin, most people are generally trading the BTC USD pair. So they assume, the dollar goes up, Bitcoin goes down. But, generally there is a correlation there, and they're not wrong to sort of see a trend in that. But there are situations where the dollar and Bitcoin can appreciate in lockstep. And I think that's sort of the scenario that happens, if you have a U.S. default. Of course, gold will move too. Gold, any hard currency would be ideal in a situation where you sort of have a sovereign default occurring on the grand stage. Now, if you have the U.S. government actually default in real terms, you probably have other countries, sort of teetering on the edge of default as well. As you know, the U.S. dollar is the reserve currency. Most people everywhere have some degree of U.S. dollar denominated assets in the form of treasuries and U.S. dollar denominated liabilities. Again, we talked about those being paired together and balanced. Well, if you rug the asset side, all you have left is liabilities. You're going to have to, there's just no way your own sovereign bond market, like if you're the European Union, how that wouldn't take a massive hit as well. Now, we're kind of going down this rabbit hole for the sake of just entertaining the notion, but I think what's important to keep in mind is that even if that were to occur, it's most likely to be very temporary in nature, but it could create, and probably would create, extremely volatile market price action. So this is not really the time to be trading on heavy leverage in the market. The market generally hates uncertainty, and while it may not, that degree of uncertainty may not be very large right now. If you did have the government start to miss some type of payment, then that uncertainty would spike very, very dramatically, and the markets would, I think the best way to describe it is, what would be clear is that volatility would expand dramatically in that scenario. And so, any heavy leveraged positions would probably not be the best move. You could ultimately get the right call and end up getting liquidated. And that would, it's one of the worst feelings in the market you could possibly have. Now, I think what the other interesting element to all this is that the timing of it is that this all happens on June 1st. And, this theoretic default that could or may not happen. The other thing that's happening on June 1st is the Hong Kong capital markets are opening up to Bitcoin and other crypto on a limited basis. Hong Kong regulators have chosen whatever asset, vetted each asset. But what is important is that Bitcoin and Ethereum are among those and the most primary assets that the Hong Kong capital markets are being open to. And so you have a scenario where you could have a potential default at the same time where just huge amounts of Asian capital is flowing into the market. So I find it very unlikely, very, very, very unlikely that Bitcoin would go down in value in that scenario, at least over a sustained duration of time. You might have some oscillation. And the other thing you have going on is you have the sort of the de-dollarization that's been going on over the last few months to a year. You have Saudi Arabia joining BRICS, Brazil, Russia, India, and China brokering a peace between Iran and Saudi Arabia. That's a huge deal because, fundamentally one of the things that the US dollar based its fundamental value on was the fact that it settled the majority of the world's energy trade, and that it was the global settlement layer for most, not only energy trade, but most trade globally. And now what you're seeing is sort of fracturing between America in the East, and broadly speaking, America and China, and America's allies and China's allies. But America and China being the two most prominent players in that scenario. Of course, China's allies are Russia, Brazil, Iran, India, and also now Saudi Arabia. Now, what's very, critical on the geopolitical stage that China's trying to do is to secure their energy independence. Because China itself is a region, a physical location, doesn't have it's not very rich in oil. So it has to depend on other countries, other trade with other countries to secure that oil production. Well, its ally Russia has one of the largest oil production in the world, and that is a significant source of their energy receivership is from Russia, but now also directly from Iran and now Saudi Arabia. And what's important here is that this energy trade is now no longer being priced in dollars. It's being priced in Chinese yuan. So the other way to kind of mirror that or to see this playing out in real time is you can look at foreign holdings of treasury securities or treasury bonds. They've been declining pretty dramatically since basically '08, but have accelerated rapidly during, basically since the start of the Russia-Ukraine war, when the U.S. Treasury seized Russian central banks' FX reserves. Foreign holdings of treasury bonds had been declining for some time up to that point, but that was really the nail in the coffin, and it really started accelerating from that point. So now you have, sort of trade between the East and the West sort of breaking down, and people, splintering off into different factions, and basically, these countries in the global South who, like South America, Africa, and the rest of Asia that's not China, are basically being forced, do they side with America for their national security interest or promise of national security, or do they side with Russia and China for access to cheap resources, cheap goods? And I think, broadly speaking, South America and Africa and Asia as a whole have decided to side with Russia for their cheap energy and China. And now you have Saudi Arabia, part of that group, adding on to Russia's supply of energy. Now, essentially what all of this trade is primarily being settled in Chinese yuan, and that can be used to buy Chinese goods, of course. China is the biggest manufacturer of goods globally. So you can buy those goods directly with the trade you do. So for example, Saudi Arabia, now when they're settling oil trade in yuan rather than dollars, they can use that yuan to buy um, Chinese goods directly, and they can also use it to buy gold. The Shanghai Gold Exchange is the largest spot gold exchange in the world, and in places like Asia, Africa, even South America, but less so South America, primarily Africa and Asia, the preference for hard money actually is stronger for gold rather than Bitcoin. Bitcoin's actually more popular in the West, North America in particular. So for them, they see, you can buy hard money directly and buy Chinese goods. So basically you have this fracturing of the East and the West. And bringing it full circle to the the Treasury default, if the U.S. government actually defaults, that, in my opinion, as long as it's not a sustained default, but it could, and you have different shades of gray here, but it would certainly accelerate that process of de-dollarization globally, right? Depending on how severe the default is and how long lasting it is. So you could even see the sort of the reserve currency of the U.S. dollar start to break down. Then people, the world sort of moving for a trustless, decentralized settlement layer, which is pretty clearly either Bitcoin or gold. I'm a little bit biased towards Bitcoin being that decentralized trust layer that will ultimately take hold. But in the meantime, if I'm being objective, there are a good deal of countries out there who are de-dollarizing, who are actively choosing gold over Bitcoin for their decentralized settlement layer. Like basically every country in Asia, and anybody who wants to trade with them, has to participate in this decentralized trust layer. And it's not a strong ask, right? They may prefer Bitcoin, but they may hold it for themselves. But it's not. If this is an event that sort of destabilizes the dollar starts to weaken its hold on the reserve currency status. It's not like the Chinese yuan will be the placeholder and the rise to the occasion of the reserve currency, because ultimately China doesn't have open capital markets and people don't trust them, and rightly so. It's just not a transparent public system. It's a system designed to repress Chinese people and Chinese workers, at the expense of maximizing export competitiveness and production. So the last thing China wants is to embrace the role of the reserve currency issuer. They would prefer to direct that capital flow into a different decentralized settlement layer. So right now, in my opinion, it appears like they've chosen gold for that. And you can see, the Shanghai Gold Exchange has always been one of the largest gold exchanges, but you can see the volumes increased pretty dramatically on that exchange over the last year. Now, of course, most people watching this are not in China. Most people listening to this video are probably in America or some, or Canada or Western Europe or some Western country. And, they're wondering, what are the implications for me? Well, I think the reality is that a default is extremely unlikely. It probably won't happen. So, it's sort of hard to entertain the low probability scenarios where you have some type of U.S. dollar default and a complete meltdown in the economy, and the Federal Reserve doesn't do anything to support the markets. That it's so unlikely that it's basically impossible, or as close to impossible as you can get in the markets. The reality of what would likely unfold is the Federal Reserve would step into the Treasury market and act as the buyer of last resort, and that the debt ceiling would be revealed to be, just a, just some arbitrary construct that isn't really acknowledged in times of crisis, right? You can kind of see how different countries responded to the COVID pandemic, and how a lot of the countries all of a sudden in a moment of crisis did not, suddenly abandon their constitutions or put their constitutions on hold, right? It's like one of those things where laws don't, they, in a crisis, national security takes over, and the Federal Reserve will perform the role that they're designed to perform, which is being the buyer of last resort, or the lender of last resort in the treasury market. So, Janet Yellen has announced that she needs to basically raise $700 billion in debt by the end of Q2, which is by July 1st, which is the most amount of debt that America will have ever tried to raise in any short period of time. So that puts a lot of pressure on yields. It's going to drive yields up. Now, they may target a certain, they may target the short end of the curve. They may target the long end of the curve. It's not really clear, what duration they'll issue the primary of that $700 billion in treasuries at. And by duration, I mean, will they issue more 1-year treasuries, 3-year treasuries, 5-year treasuries, 10-year treasuries? That's impossible to know. But what we can know is that, broadly speaking, issuing $700 billion in treasuries will drive yields up, specifically on whatever end of the curve they issue them on primarily. And that'll put a lot of pressure on the treasury market. And, if the U.S. government needs to raise $700 billion to fund its operations, that means that there needs to be $700 billion of demand to buy those treasury bonds. Well, what happens if you only have $100 billion of demand? Right? You have these treasury auctions, and you only sell $100 billion, and you need to sell $700 billion. Well, that's when there's a real clear dysfunction in the treasury market. And that's exactly the moment when the Fed will step into the market. Now, the Fed would prefer for organic demand for treasuries to exceed the amount of debt that the government wants to raise, for obvious reasons, right? Because while they are the lender of last resort, the buyer of last resort, they know the consequences of them performing that role, and right? They know it'll lead to inflation. They know they're in a battle with inflation right now, but ultimately that's their role. If they're not able, if there's only, if organic demand only covers half the amount of debt that the U.S. government needs to raise, the Fed will step in as the buyer of last resort and cover the other half. That's just the reality of it, and that means a debasement in the currencies. One way that this whole fiasco with the debt ceiling sort of illustrates, or one thing it should illustrate for people, is that the current system is structured like a Ponzi scheme. And the thing that, people may not necessarily realize that right away, but if you just take the concept that, the government would have a hard time paying $100 billion of debt without raising more debt to pay down that $100 billion of debt. So in order to pay down their debt, or to pay their bondholders, they have to raise new debt, right? And if they would have a hard time paying $100 billion in real terms, they have $32 trillion in debt, and if you add unfunded liabilities, it's $200 trillion. The reality is that they're never going to pay that debt off. The only way the bondholders are going to be able to get repaid is by issuing new debt. So there is essentially a $200 trillion loss on the books. And now really the question is a political question, which is what portion of the population bears that loss? And, that's not clear how that's going to unfold. Different political parties have different ideas around who should bear the loss, but the reality of the situation is that someone will bear the loss. and it'll be reflected in the bondholders and the currency holders ultimately. Now, bondholders get a yield, so if bondholders are being repressed, that means currency holders are being repressed even more. So one way that financial repression takes place, for bondholders, is say inflation is at 15%, and you're holding a bond that yields 5%. Well, the yield on your bond is 5% in nominal terms, but the real yield is the differential between the nominal yield and the rate of inflation. So the nominal yield on that bond was 5%. The inflation in this scenario was 15%. The difference between that is 10%. So the real yield on that bond is minus 10%. So you can see how, in that scenario, that 10% differential goes to the government at the expense of bondholders. But of course, currency holders are even more repressed because they're negative 15%, right? They don't even get that 5% yield. They just get the inflation, 15% inflation. So I think, it's pretty clear that despite all the nuances and how the losses are allocated, that they'll ultimately be allocated to people who hold currency, or who hold large amounts of it. And not many poor people really hold large amounts of currency, but their wages are denominated in a fixed wage, right? I mean, they may get a raise here and there, but it certainly won't keep pace with inflation. And if you extrapolate that out over time, it only gets worse and worse, right? Inflation rises exponentially, and wage growth, doesn't. It's either stagnant or growing linearly. So it's just a problem that gets worse and worse over time. Anyway, I know it's a little bit of a meandering video. To cap it all off, I would say that I don't think that U.S. default is likely. Governments generally don't default in currencies in liabilities that are denominated in the currency they can print. They generally default in nominal terms, meaning they print the difference between what they owe to bondholders and what they're actually able to pay. And that means more money printing, which is ultimately good for hard assets. You're sort of in a situation here with hard assets where it's really hard to see a scenario where you can lose over the long term, right? If you take away short-term volatility, either the government defaults or they print trillions of dollars, right? Both scenarios would be bullish for gold and indirectly bullish for Bitcoin as well. Anyway, I hope you guys like this video. If you haven't subscribed already, please make sure to do that. I'm going to make sure to upload more frequent videos